is the biggest risk in China?
So the story of the China risk is a combination of a slowing economy and significant amounts of leverage. There was a very good report from the IMF published this week. It's their Article 4 report, and it highlights that China's leverage within its economy is very, very high relative to its per capita GDP. We have total social financing at around 195% of GDP. So you combine that with a story of slowing growth, margin compression. We've had 16 months of declining prices in China for manufactured goods. The PPI has been falling for 16 months. That's the longest period of deflation we've seen in China since 2002. So that's output prices, but input prices are going up, particularly the price of labor. So we have a margin compression story in a very leveraged economy, which could lead through to problems with asset quality, not from the shadow banking system, but from normal corporate loans. The other area of leverage which came out of this report is the state of the fiscal position in China. The IMF estimates that the fiscal deficit in 2012 was 10% of GDP. Their estimate looks at the financing that was done by local government funding vehicles, looks at land sales, looks at other increases in debt. So we have an economy where the fiscal position is very constrained, where the credit to GDP is too high, and policymakers have been indicating in the last month or so that they're uncomfortable with that. We've seen a spike in interbank yields. We've had a message from the PBOC for banks to be more prudent in managing liquidity. So it appears as if we're going into a modest tightening cycle relative to financial conditions over the last 12 months. We're going to see a slowdown in growth, a further decline in profits, increased risk in the financial system, and policymakers are extremely constrained. As I've said already, monetary policy is tightening, fiscal policy is already very stretched, and I don't think there's much flexibility to weaken the currency. So China looks as if it's going into a multi-quarter decline in growth. And what we hope is that they can manage that and avoid a financial problem. But that's going to be quite difficult for them.
And what are the implications of these risks for emerging markets?
Well, I think the implications feed through at a number of different levels. China is the largest emerging market as a percentage of the benchmark. It is 30% of EM GDP. You then get the second biggest emerging market. Brazil is very dependent on China's demand for commodities. And Brazil's very challenged at the moment with rising bond yields, very low growth, less than 2%, and still quite high inflation. So I think for emerging market equities, with two of the biggest markets facing some very negative fundamentals, I think that's bearish for EM equities. Now, how it impacts the economy? Well, if you think about Korea and Taiwan, their biggest trading partner is China. This is bad news for petrochemicals, bad news for steel. It could start to feed through into the consumer story. There is evidence that inventories are rising in the auto sector. And we've seen the retail sales data at a company level, so looking at same-store sales, reasonably weak. So those that export to China are going to suffer from this. There will be some modest benefits. If commodity prices continue to decline, big commodity users will benefit from lower input prices. But I think the benefits are much more smaller, more modest than the disadvantages for EM.